Right, everybody, ladies and gentlemen, hello and welcome to Nadex, to our third part of our premium trading strategy course. Today we want to see call spreads and binaries in action with the strategies that you have learned during the first two parts of this webinar series. My name is Philip, and I will be a presenter for today's webinar. Just a quick sound check. Ludmila, thank you very much for already jumping in and giving me that feedback that everything is working. Really appreciate it. Guys, perfect. Thank you very much. And those of you who are new to our sessions, you can see that small questions box. And please, if anything is not clear, if you happen to have questions, which I hope you do, because it shows me that you are working with the content that I'm giving you here today, put those questions into that small box, and I do my very best to answer those questions as we move through the webinar, which, by the way, is scheduled to run for around about 1.5 hours. So before we get started, you already see those first risk disclaimers here, and please take a moment of your time to read through those. I have to make you aware of them, so please make sure that we are on the same page here before you're continuing with this webinar. Essentially, this says that trading, of course, involves risk. And we should understand those risks and the instruments before we are getting active in the market. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only. Today, it's not about live market conditions. Those screenshots do not reflect the current markets. And so it's really there just for educational purpose to illustrate ideas and to explain how we would go about to trade certain setups with the strategies that you've learned in the first two parts of this webinar series. That being said, here is the Nadex risk warning. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative for future results. Nadex contracts are based on underlying asset classes, including forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's just get started. Today's agenda, you have learned our two core trading strategies in the first and second part of this webinar series, the trend flow strategy and the momentum breakout trade. And we want to show you guys first a quick recap of those strategies. Then we want to show you guys potential trading opportunities in the markets and how they could have been executed back in the day using those Nadex contracts. And we want to kick it off with the trend flow trade example, what trading factors can we control, and the importance of flawless execution. It's always important to understand that trading is a game of probabilities, and we will never be able to control everything. Many things are completely outside of our control. We have no means to influence, for example, the outcome of a trade, of any one given trade. The only thing that we can do is we can try to stack the odds in our favor by collecting small advantages, stacking probabilities. And once we've understood that and we can execute that, flawless execution, we have to make sure that we don't screw up during those parts that we can actually control. So we have to be consistent with our trading execution. We have to make sure that we interpret the charts the same way all the time, that we don't say, one time, that's good enough, and tomorrow looking at the same chart, no, I would never take that trade. That's just not good enough. No, we want to be consistent. We want to have the same strict set of criteria for entering our positions and to manage our trades. And this is what we like to call flawless execution. We aim for perfect execution of our trading strategy. Next step, momentum breakout trade examples. Once again, we're looking at charts, we're looking at the type those markets have been setting up, and then we want to analyze and understand once again, now that we understand what the market is, what the setup is like, how can we actually trade this using Nadex contracts? Because Nadex contracts, you know, you do have to think about expiry cycles. You do have to think about those two different types, and now 3 different types of trades, trade types available for trading here. And also, of course, let's talk about which different strike price, which different brackets do you want to pick when it comes to implementing that trade setup. A complete trade from start to finish, comparing call spreads and binary options available. A major part of trading success is also having the proper mindset and putting yourself in that sweet spot that you can survive the learning curve. Let's be honest, if you're just getting started with something, you will screw up. That's perfectly fine. I know I screw up a lot of different things if I'm getting started, or even if I'm already a seasoned professional. To err is human. That's the way the ancient Romans put it. Errare humanum est. It's just in our nature, we will screw up. So we must make sure that we can do as little harm as possible when we are screwing up. We like to call this whole section surviving the learning curve, making sure that we will be still here tomorrow to trade and to try again. Other trading scenarios, putting Nadex contracts to best use, is how we want to wrap up today's session. And just a quick reminder, guys, if there are any questions, please let me know. I want to teach you guys something, and if you're asking questions, obviously, first thing, you have listened to me, and second, you have started to think about what I said and try to put those things into action within your mind. And I think that's the vital first step on your trading journey. So identifying a directional bias, bullish or bearish. We have covered in detail during parts 1 and 2, the trend flow strategy and also the momentum breakout strategy. It's good and important to understand what we see on that chart. People think often they just want to trade. I have a trading window from 11 a.m. to 1 p.m. and this is when I want to trade. If there is no setup during that time of the day, I don't trade, even though I'm watching the markets, even though I'm stalking the charts and try to look for something tradable. If there is no trade there, I don't trade. You want to have a strategy in place, and only then do you want to execute that strategy. And the strategy is all about identifying potential setups. What is the market doing? And it's not that just because you think you're trading binary options, those binaries are, you don't have to have a setup. It's just the market is going up or down. No. You want to have a setup all the time. And once you've understood what your setup is, then the question is only, how do I want to implement that strategy? How do I want to trade that setup? The picture that I like to use is, first, I must know that I want to go from New York City to Chicago. And then it comes down to, how do I want to get there? Do I want to get there by train, by plane? Do I want to drive my car? Whatever. But first, I must know that I want to go from place A to place B. And this knowing from place A to place B, this is what my strategy does give me. And then I can think about implementing it with a call spread, a binary option, or the latest to the game and to the table, also using touch brackets. So we'll also look at how you can profit using the binary option in a slow sideways market. Very powerful thing. Talking about options and looking at options. If I think that I've identified a certain type of setup which results in the market going nowhere over a certain period of time, options give me that opportunity to potentially cash in on that situation, on that type of setup also. The great thing about a binary option is that you don't always need to be bullish or bearish. You can expect sideways activity and benefit from this too. So let's have a look at some trend flow examples. What is it that we do see on this chart here? And let me grab my laser pointer for that one. We're looking here at a certain market and at a certain time frame. Happens to be euro against the US dollar on a 4-hour chart. It could be any market, it could be any time frame. Remember, we want to use that same set of indicators, of analysis techniques, independent of market or time frame. We want to trade price action and what price action is showing us, and not a specific market, not a specific time frame. And here happens to be euro US dollar on a 4-hour chart. And if you paid close attention to the first 2 parts of this webinar series, you will now understand why, if I saw that type of setup in the live market right now, I would be getting really interested into that type of setup. What is it that I like about this market? Well, the first thing is immediately I can see that I have optimal chart structure. This optimal chart structure just tells me candles are very close to each other. There are no nasty gaps. Maybe here was a little gap, but this could have been easily the distance from Friday evening to Monday morning opening. Overall, those candles are sitting just next to each other. No nasty gaps, no nasty surprises. One of the reasons why people like to trade those types of markets, forex, for example, commodities, compared to stocks, because with stocks you always have this overnight risk. One bad press release overnight, one new SEC investigation, and the market opens completely in a different place, and you have no chance whatsoever to get out of this market. If you have optimal chart structure, prices trading very close to each other, yes, the market will move, and it will move fast in those events too with forex. But the markets are open. You can cut your losses. You can just get out of that position. And once again, the big benefit with Nadex contracts, you know your risk exposure up front. And the way that we like to trade and scale our positions, more about that later on today, I don't have to watch those markets. I know my maximum loss up front. I've position sized my trade accordingly. And therefore, if bad things happen, so what? It's all completely within the limits, within the parameters that I've set up for that trade. Good optimal chart structure, trending market. I can see that we are in the context of a downtrend. How do I know it's a downtrend? Well, I just compare the lows on this chart, and I can see that the market is making lower lows. I can also see that the market is making lower highs. And from time to time, we get those pullbacks to price equilibrium levels, and we use the 10 and 20 period moving average to help us to identify those price equilibrium levels. So new lower low, price is pulling back. Where does it pull back to? Price equilibrium levels. And I'm starting to see some bearish price action setting up here right now. Next thing to notice, it's not just that the 10 period moving average is trading below the 20. No, they are both below the 50 and below the 200. Remember, we like to call this our fanning pattern with our moving averages. I only get this fanning pattern, I only get this structure of those moving averages if the market is in a good, strong trending environment. This is what I see here right now. So nice trend, good chart structure, price is pulling back, bonus points. This last move lower was a very steep move, and for that very reason, I'm also seeing good convergence here with MACD and with RSI. Not part of our core trading rules here, but definitely a bonus point for my own style of trading. So all things coming together, we've pulled back. We're seeing rather smallish candles right now, bearish candles setting up before the market might be poised to go lower. That's the chart that I intend to trade. That's the 4-hour chart. Now let's have a look at the next higher time frame. Stacking the odds in our favor. We want to gather as many advantages, as many probabilities, suggesting the market is going lower as possible. And a major part of that is we want to see that the next higher time frame is in agreement. Rule of thumb is we want to double the time frame that we are analyzing and intending to trade. We intend to trade the 4-hour chart, so let's have a look at the 8-hour chart and understand what's going on here. And guess what? The 8-hour chart too also is giving me a nice downtrend, also making lower lows, also making lower highs. We also have this fanning structure in our moving averages here. All this tells me that this move lower isn't just a very brief flash, but rather continuous move, a continued move lower. Because otherwise that higher time frame wouldn't tell me exactly that same story. Next thing, convergence here in MACD, convergence here between those new lower lows, also with RSI. Price is also trading very close to price equilibrium levels here with a small bearish candle setting up here on the 8-hour chart. all those things coming together suggest that this might be a nice trading opportunity here at that point in time on the euro US dollar. Guys, so far, any questions here on that set of indicators and analysis techniques? Anything not clear from the first two sessions? If so, please just let me know. More than happy to answer your questions there. So the question is, how can we trade this right now? We think the market might be poised to go lower. Of course, we are not sure. We never will be sure. But we think it's way more likely for the market to go lower. And way more likely is good enough for us. Because I know that if I trade that type of setup 100 times, I probably should be able to come out ahead with that setup 60 out of 100, maybe even 70 out of 100. There will be always losing trades. And it's important to understand this and to accept this. And just because that trade might not be working out does not mean that you screwed up as a trader. It's just part of the game. It's just like if you run any business, you will be getting invoices. Having to pay those invoices is part of the game of running a company. And having losing trades is just part of the game of being a professional trader. It's just the cost of doing business. We have stacked the odds in our favor. How can we trade this? And one thing to be aware of right now is we have to think about the different expiry cycles. And with this type of setup that we're looking at here, we're looking at a binary contract with a strike price of 135. Why 135? Well, if you look at that chart, you can see that the old low was sitting there pretty much very close here to 135. What is my expectation? The expectation is that price might be going lower. We're testing, and at least testing, if not even going for a new lower low. Downtrend, lower highs, lower lows. My expectation is that as long as this downtrend is intact, I want to see the prices making new lower lows. So at least I should be able to get a retest of this 135 level, if my basic assumption holds true. So that's the strike price. Now, with this specific expiry cycle that I took, we're looking at about 20 more hours left until expiry. Just in this example, round about 20 more hours left. Now, we're looking here at a 4-hour chart, which means if price is about to move in our direction, 20 more hours to go means I'm about to get 5 more candles on this chart. And thinking about how many more candles do I have on that chart, actually, I think is rather beneficial and a rather easy way to anticipate is the speed of the market, is the volatility good enough in order to give me my potential profit target within the time limit available. So 5 more candles for price to drop down to 135. I think that's absolutely plausible and absolutely can happen. I don't know if it will, but makes sense. Makes perfect sense and could be working out. So what's the trade here? The trade could be to sell this market right now, sell this contract for 84. Why 84? Because it's trading in the money. Remember, this contract will settle for 100 if price is trading above 135 at expiry. So what is my risk on this contract right now? My risk on this contract right now per contract would be just $16. I sold it for 84. Maybe have to settle for it and settle it for 100. Okay, what's my downside? $16. However, if price closes below 84, if price closes below or at 135, then I will be able to keep all those $84 which I just got for selling this contract. Does this make sense, guys? Why 135? Because I think that's the level that we had previously, and I think we have a decent probability of retesting this level within the same period of time available for trading that contract. And Very beautiful reward to risk ratio on that trade. I'm just risking 16 for potential opportunity to make 84. Is this how I would trade it? Probably not. I would like to set up that trade, but then start to scale out once price is about to approach this 135. Risking $16 per contract. I could try to lock in part of my position, scale out of that position if price starts to drop another 16 points. So if price is about to drop to, should be, oh boy, 68. I think it should be 68. So if I could put in a limit order to buy, to close a part of my position, if price drops down to 68. Scaling out, actively managing that position. But the overall setup here is I'm shooting for 135. Price is about to go lower and hit and retest this level there. Let's have a look at another example. Here we're looking at British pound against the Japanese yen. Doesn't matter at all. Once again, I'm looking at the same things. What is it that I like about that chart? Beautiful, well-established downtrend. Lower lows, lower highs. I get my fanning structure and my moving averages. Price is now just pulled back to price equilibrium levels here. And right now, the one thing that doesn't terribly thrill me here is, but remember, that's just my personal style of trading, and a bonus point at that stage, I do have some divergence here as price made this new lower low. Very, very minor in RSI, more pronounced in MACD. However, here on the big picture, next higher time frame, 4-hour chart, 8-hour chart, and it would be absolutely the same interpretation if this was a 15-minute chart and this was a 30-minute chart. It's just about double the time frame for confirmation, and that's it. Downtrend also on my confirmation time frame. Lower lows and lower highs. Price is also sitting quite close here to my moving average sell zone. Could be closer, could be better there, but overall looking nice, and all things coming together here. Time left round about 16 hours. So round about 4 candles time for price to hit my potential target level or trade below that target level, depending on how you want to manage your trading position. And those are the different strike prices and contracts available for trading here. So how would I go about to look at a potential trading opportunity and finding that contract here? Well, the previous low was sitting at around about 119.50. So 119.50, we don't have that one. We do have a 119.60 or 119.40. Same way to approach that trade than on the previous slide. I could be selling this market right now for potential risk of around about $34. Gives me round about a 2-to-1 potential profit target if price actually trades below this level at expiry, 119.60. Do I think it's likely that price will drop all this way within 4 candles? Well, the speed of the market definitely is there. Can happen. It's not really shooting for the stars. Shooting for the stars would be to say, all right, I want to sell this 118.40 contract because my risk on that contract would be just $5. However, 118.14 should be way down here. I hope you can see that price has to travel quite a bit within those remaining 4 candles or 16 hours to give me that potential profit target. Obviously, risking $5 for the potential opportunity to make 95 is awesome. It's completely outstanding from a reward to risk ratio. The probability that this can happen, however, is rather small. Being pretty conservative at that point would be shooting for, where's price trading right now, very close to 120.0. So I could be looking at this 120.0, and guess what? It's trading at the money, and therefore price should be very close to 50. That's a good rule of thumb that you can keep in mind. Is it always the case? No, it isn't, but it should be like that more often than not. If the underlying market is trading around the strike price of a binary option, the price of that binary option should be somewhat close to 50. And you can use that later on to actively manage your position and to start to scale out of that position, for example. Here right now, trading at the money, selling this contract for 120, my reward to risk ratio on that trade would be very close to 1-to-1. Price starts to drop, and it should be rather likely, or very likely, that price will be below this strike price with my analysis and everything performed. So for that reason, decent reward to risk ratio, not great, not outstanding, but absolutely okay. And very high probability that this one is going to work out. I could also be looking at selling here this 121. But the reward to risk ratio on that one would be really bad. Why? Well, I'm just getting $13. However, if the market now completely reverses and shoots higher, I would have to settle this contract for $100. So the risk on that trade would be $87. Risking 87 for the chance to make 13 just doesn't make sense to me. Yes, I have probabilities on my side. However, this is just too bad of a reward to risk ratio for me to actually consider that trade. Which of those strike prices you pick completely comes down to your personal preference, to your risk appetite, and, sorry to say it, but to your greediness. My suggestion would be, don't be too greedy. Be sensible. 4 more candles, 16 hours until expiry. I'm looking to trade a 4-hour chart. 4 more candles. What can I expect from the market without the market trying to do the next Usain Bolt move? Here we're looking at the outcome of that trade, and sure enough, 119.50. Yes, we got a retest of this level, and guess what? Price dropped all this way, going into all that direction here, and so pretty much all of those different strike prices that we saw would have resulted in a potentially rewarding outcome of that trade. Just reading a comment here from David, and David, I absolutely agree. David said, you'll be shocked at how often that most likely in the money trade can go sour, eh? Yeah, absolutely agree. And this is why you always want to plan for the worst possible outcome of that trade. And this is one of the reasons why I really, really do like the Nadex platform. Let me just go back here, because on the platform and the way those trades are structured, you always see that worst possible outcome directly the very moment you're about to submit your order. You can see the maximum loss right here and there. So that trade, selling 15 contracts, just gives me a maximum loss of $240. I know my risk exposure up front. And this is if the market shoots to infinity and beyond, or I don't know what's going to happen next. This is the worst outcome. I know this up front. No nasty surprises, no waking up in the morning, and by the way, your stock dropped 90%. This is something I can happily do without, and Nadex just gives me that peace of mind, giving me that risk exposure up front. So absolutely, most likely is not certainty. David, thank you very much for that. For that confirmation from your experience here. All right, so price dropped here. Coming back to our example, price dropped, and pretty much all of those trades would have worked out. Your risk appetite, can I expect for price to drop so fast and actually pick up some speed and momentum here? No, I can't expect that. Middle ground, something sensible. Do I want to have the most outstanding reward to risk ratio? No. Do I want to have the highest probability? No. I want to have some middle ground of both. Don't be greedy. This is not something that you have to win with one trade. You want to have many trades on, because only with many trades, all flawlessly executed, those many trades can work that strategy for you. Law of big numbers. It's all about statistics here at that stage. And therefore, you want to have many trades and you want to stay small. with all those trades. And then let just this number game sort it out for itself. So, results and flawless execution. In trading, we must focus on aspects within our control. We have complete control over what different types of trades do we take. Is that trade setup good enough for us right now, or is it just not good enough? It's good enough story time. When I learned those strategies, I always had this eagerness to find setups. I wanted to have those setups. I wanted to trade those strategies. And at one stage, I realized I asked myself quite often that question, is it good enough? And this is when I realized if I have to ask myself that question, is it good enough? I know that the trade setup is not good enough. At least at some level of my perception and consciousness, I have doubts about this setup. Otherwise, I wouldn't have asked myself that question. You only want to trade the best setups. So shooting only for the best setups out there, this is completely within our control, within our grasp. Which trades will we take? Does the trade truly meet every one of our strategy criteria? Contract selection, next thing. Which strike price, which expiry cycle, has that trade enough time to work out? Personally, I tend to give this trade rather more time for it to play out than to be too aggressive on the expiry side. And then, of course, big question here is also how many dollars do we actually risk on that trade? Risk management, more on that, at least a little bit later on today. We have to accept that we do not have any control whatsoever considering the outcome and result of this one trade. The outcome of this one trade is and will always be completely random. If I trade that same trade at that same setup 100 times, it's a different game because now probabilities start to work in my favor. But one trade absolutely means nothing. Detach yourself from the result of that one trade. Decouple your emotional state and happiness if that one trade did make you money or if you lost money on it. Focus on flawless execution. The best we can do as traders is to trade well. We cannot control the market. If you want to learn more about this complete mindset aspect, by all means, I highly suggest it and recommend it. A good way to get started there are the books called The Disciplined Trader and Trading in the Zone, both written by Mark Douglas. Trading mindset, huge point, huge roadblock for those not aware to ultimately make it as traders. So trend flow trade number 3, we're looking here at an 8-hour chart. Next higher time frame that we want to analyze, therefore, is our daily chart. What is it that we want to see here on this chart? Well, first thing I can see, price is in an uptrend, higher highs and higher lows. I can see prices now pulled back to give me a new higher low, and sweetening the deal here is price has pulled back to form a level. I know that this is a level because price bounced here. We had a very brief and short reaction here, but now ultimately price bounced off this level here and now. So pull back a little bit beyond our moving average buy zone. However, small candles setting up, everything coming together, suggesting that price is finding support here at this level. And can we get a push higher? Can we get a test for the next, at least for the old high? Maybe. Let's have a look at the daily chart. Nice uptrend, much clearer uptrend, much better uptrend here on the daily chart. You can see the moving average buy zone has closed down here on the 8-hour chart. On the daily chart, just sitting there, and a much better chart structure here. Small candle, very close to a moving average buy zone. Strong convergence here, not only here in this area, but also there and there in MACD and RSI, supporting that potential trading decision here on the daily chart. Which contract, which expiry? We have to look at the details here and think about what we could be picking here. But overall, it's a nice trading opportunity. Which strike prices would make most sense? Well, to be conservative, looking at trading at the money, a strike price where the market is trading right now. So we could be looking at this price, we could be looking at the level price, or we could be looking at trying to find something which is very close to the old high, because basic reasoning again, price is about to shoot higher, at least that's our anticipation. And so if price is about to make a new higher high, and even if it fails to do so, we should at least be able to see a retest of this old high. So strike price close to that old high would definitely also make sense. Let's have a look at the contract selection. And let's just briefly go back to that slide to just pick the levels. The old high was very close to 92 and price is trading right now at 0.90, just points of reference. So 0.90, and guys, just remember what I said before. If the underlying market is trading very close to the strike price, we would expect to see a price very close to 50. 42 to 49 is very close to 50, at least in my book. And this is why this is the conservative setup, where I say, okay, I could be buying this market right now for 49, and I think price will be going higher, and sure enough, value of that contract should appreciate as price is going higher. Now, the old high was very close to 92, so I could be looking at that contract row here, 91.75. I could be buying this contract for 14.50. Risking 14.50 for potential profit target here, or profit of a 5.50. Outstanding reward to risk ratio, maybe a little bit on the aggressive side, but also can make sense. The question is, are you slightly bullish? Are you very bullish on this upcoming move? Just a food of thought. Why decide between those two? Why not split it? Why not take half of my risk exposure on the one at the money, and why not take half of my risk exposure on the trade, on the way more aggressive trade? We're looking here at the 90.75, and we're looking at the 91.25, for example, and you can see that the maximum loss here out of the money way smaller than here. Reward to risk ratio, however, worse. There is no right or wrong. It comes down to your personal preference, to your risk appetite. Yeah, let's just say it. It comes down to your greediness. How aggressive do you want to be? It's just important for me that you guys can see that you do have many options available to structure that trade. It's not first common misconception about binaries. It's always it's one or all, it's fire and forget. No, you can actively manage that position. So if I'm looking at this trade here for 14.50, buying this one, for example, what's my risk on that trade? Well, it's 14.50. Let's forget about commissions here for a moment. 14.50. So do I have to hope and pray that this market will close above 91.75? No, because I can manage that trade. So if price actually starts to move higher, the value of that contract should also increase. And what I can do now is, if I'm having a risk of 14.50, I can put in a sell limit order for 29, which just means I've personally defined a 1-to-1 profit target. I'm risking 40.50 for the chance to make 14.50, at least for a part of that position that I have on. Think about actively managing that position. So I don't have to hope and wait that price spikes above this level and remains above that strike price until expiry. No, one short spike beyond that strike price can be good enough for me to actually lock in some of those profits here using my binary options. Just keep that in mind. Once again, overall, it all comes down to your personal risk appetite. Other trade example here. This time we're looking at the Dow Jones Mini. We're trading once again a binary contract. daily expiry cycle, and we're looking at the 2-minute chart and the 5-minute chart, just the same style of trading. 2 minutes, beautiful uptrend, higher highs, higher lows. I can see price pulled back to price equilibrium levels. We are a wee bit overextended here, and we will have to see what's going on there. 5-minute chart, tough call here. This has been a downtrend all this time. The 5-minute chart has just shot higher here. Is this an uptrend on the 5-minute chart? I don't see it. We could consider that to be a high, and this would make a higher high, or this is the same level high. Overall, this higher time frame is not, for me personally, in agreement for with what the 2-minute chart is telling me here. Nice chart structure on the 2-minute chart. The 5-minute chart just isn't there yet. And it's not just about seeing that the 5-minute chart is not there yet. I can also, that the trend is not fully clear. Moving averages have not yet fallen into place. Remember, for a trend flow trade, I want to see that the market is in an agreeing trend on 2 different time frames at least. I want to see the moving average fanning structure across those different time frames, all those things coming together. I just don't see it here. However, if I drop down to a 1-minute chart, that might be in agreement with what the 2-minute chart is telling me here, and I could be thinking about potentially trading then the 1-minute chart. The 2-minute chart, however, for me here just doesn't make sense, as the 5-minute chart does not agree. And therefore, the setup for me is not there, and therefore it doesn't make sense to even look at the strike prices. Would be way too aggressive for my own personal taste to just see one time frame going in one direction and the other ones not agreeing here. All right, so seen enough of those trend flow trades. We find the best way for you to learn what we teach is to reinforce and test the principles over and over again. And so that is what we shall do. Quick reminder, if you don't have that demo account, please consider opening that demo account and using that demo account. Just getting a feeling for what the market is doing and exercising and strike selection and doing all that. This is a really valuable lesson that you can learn. The demo account will not prepare you for the emotional stress of trading. No way that I can achieve that. But getting the technicals down, practicing different strike prices, using different contracts, scaling out of positions, trade management, fast execution, looking at the 2-minute and 5-minute charts, for example, all those things coming together, you can practice a lot here with the demo account without actually putting any money on the line. Highly recommend and suggest it. Statistics time, typically trend flow trades will set up more regularly than momentum breakout trades. Personally, I think that those trend flow type setups make up about 80 to 85% of my own personal trades. The momentum breakout trade really is just coming on top of it. So this is why we also want to focus here on the trend flow strategy more than on the momentum breakout trade. And big advantage of binaries is we usually almost always have a suitable contract and strike available when trading binaries. Call spreads are limited to intraday trades. And for that reason, if you want to trade that longer time frame, give that trade a little bit more wiggle room, usually you probably will end up with picking a binary. Shorter time frames, I really do like my call spreads. Be aware of those. So it's not that one is better than the other. It's just the right tool for the right task at hand. All right. Therefore, more focus here on trend flows using a binary. And let's just have a look at a few more. And while I'm reading a question of Raja, I hope I didn't butcher your name here. Guys, if you have questions, quick reminder, put them in. Yeah, the question Raja has been asking is, when the 5-minute chart does not match the 2-minute chart, is that usually a sign that the trend is going to change? That is a big trade setup. Also, is the 2 or 1-minute trading available? Because on my platform, I always only see the 5-minute binaries as available. Multiple questions here. Thank you very much for those. Talking about 5-minute binaries, we have to distinguish here between the time frame or the life cycle of those binaries and the type of chart that I want to trade. Yes, usually you want to trade those very fast expiry cycles, also on very fast time frames. However, you don't have to do that. If you think about it, if price starts to push in one direction fast, that rule of thumb, the price should be close to 50 if the underlying market is trading around the strike price. That should be true for pretty much all different expiry cycles of those binaries. So that should be true for a weekly binary option and also for the binary option which is on that 5-minute cycle. Personally, I'm getting rather old, and for that reason, I'm looking to trade only those higher time frames, not only in the charts, but also from those expiry cycles. But you don't have to do that. So just because I'm looking at a 5-minute chart or 15-minute chart does not mean that I can't trade weekly binaries with those setups. Just keep that in mind. The next question was those different time frames and why should they be agreeing? Price changes and trends ultimately run out of momentum and will also break and will start a new trend or a sideways phase. Where does this change actually start? It always starts on lower time frames. So it will be first the 1-minute chart that is no longer in a downtrend. And the 1-minute chart will switch into an uptrend. The 2-minute chart will follow suit, but it takes some time. The 5-minute chart, pretty much the same story here. So obviously, you will always see that those trends change on the lower time frames first. And if you want to practice one thing, it would be for me to suggest that you try to get a feeling about how those time frames represent each other. What if I'm looking at a daily chart? What is the 4-hour chart probably looking like? If this is my daily chart, what is the weekly chart probably looking like? If this is my 4-hour chart, what is the 2-hour and 1-hour chart most likely looking like? Getting a feeling and understanding for how those time frames connect with each other is so beneficial for your overall trading success. It just gives you that understanding on how do moves look and why a certain combination of different time frames and chart patterns on those different time frames way more plausible and gives us higher probabilities for trade setups than others. And the key thing here to take away is we want to see agreement. Yes, I know that the 1-minute chart has to change first. Is this an indication that there is a big change of trend coming? No, absolutely not. It could be just a quick move into a sideways phase or something else. Overall, the higher the time frame and the more well established the trend on that higher time frame is, the more significant and important that time frame and that trend should be. If you look at the 1-minute chart, 5-minute chart, you usually will see a lot of noise on those different charts. And you get usually a much cleaner chart structure if you look at a 4-hour chart, at a daily chart, at a weekly chart. All this small up and down, all this noise pretty much has been removed from that perspective. And this is why I feel that setups on higher time frames give us better trading opportunities, more plannable trading opportunities, and also if more of those higher time frames are in agreement, this is way more attractive, at least for my style of trading, than seeing that the 1 and 2-minute charts agree. 5-minute and 10 and 15 minutes tell me a completely different story, however. I like higher time frames and I like more time frames to be in agreement, not just the 2 that we at least recommend. So I hope that answered that question, and please by all means keep those questions coming. Gold, weekly binary. We're looking here at the weekly chart, and we're looking at the daily chart. So what is it that I can see here on those charts? Well, the weekly chart just gave us that sweet pullback in a well-established uptrend. We got this pullback here to price equilibrium levels. Looking at small price action right now, and it really looks like this pullback might be over. Large candle here. Yes, it's a red candle, but this move to the downside, this long lower shadow, which got completely rejected by the market, that was a good first indication that the market might be poised to go higher. And so the weekly chart giving me a strong environment here for a potential up move. What is the daily chart doing here? Well, this is a downtrend at that stage. However, yes, just look at what the move looked like on the weekly chart. Sure enough, price had to drop sharply over multiple days, multiple sessions to give me here this move to the downside. However, since then, let me just try to draw this in. What immediately catches my eye here is I have some kind of flat level right here, and price has now just started to make a series of higher lows, and price is compressing against this flat level. Price is trying to push higher, got a short breakout to the upside, came back, and now once again, and this looks here, that small green candle looks to me that the market might really try to push higher. Now, what type of trade, what type of contract would I like to pick here? I'm trading the daily chart, so it doesn't make much sense for me to try to find a contract which is not on the weekly chart. Sorry, it's not on the weekly expiry cycle. Obviously, one candle takes 1 day here, and price, I have to give that trade some time to play out. Where are we trading right now? We're trading at 1692. So I could be going for this 1693 contract. And remember, if it's trading approximately at the strike price, price should be close to 50, 45, 51.50, perfectly spot on here. So that's a nice contract here to consider. The question is, which contract would you pick? And the question now is, why? And would that assessment change if it was Monday or if it was Friday? And obviously, you will pick different strike prices if there's more time left in the life cycle of that contract. Let's have a look at examples here, and let's just shoot for this 1703, for example, already more attractive from a reward to risk ratio. The 1713 as well, and you can just see that this is all you're trying to shoot higher. The question is now just how much time does this trade actually have? How fast do I have to make that judgment call? The price actually starts to that contract expires, and this will completely determine which type of contract I'm shooting for here. Remember, personally, I never would like to go below a 1-to-1 reward ratio. So here, looking at buying this contract for 51 for a risk of 51 for potential gain of 49. Not awesome, but absolutely fine. Here, 60, 68, no. Reward to risk ratio already way too bad for me. And here the question is, how aggressive do I want to be and how much time is left in the life cycle of that option? I hope that makes sense. If not, let me know. I'll do my very best to explain those things even further. Ludmila, thank you very much. I completely agree here. Ludmila just said, I'll pick the contract closer to the strike price because we're left with 1 day before the market closes for the weekend. And this is perfectly fine. This is, personally, I like to play it safe. You don't have to be a hero to win this game. It's not about today. It's about the next 100 trades. It's about how well you perform your strategy over the next 10 years. Those people who tell you I started with nothing and I will be a millionaire tonight. No, trading just doesn't work like that. Yes, those are the stories that make the headlines. Trading is a business. You want to play it safe. Small, steady gains, calm and steady, as I like to call it. Ludmila, absolutely agree with your approach here and your assessment. Just reading another question here. Another question about those different time frames and if change is reflected during those. How shall I put it? Yes, price changes will be much faster reflected on the shorter expiry cycles. Without going into much detail here, this is delta, this is gamma kicking in and driving the price of delta. And for that reason, yes, sure enough, short time to expiry, price changes, price will fluctuate much faster, much more rapidly than on those higher or options with a longer time to expiry. However, price will also be reflected there. And personally, all this, you have to like this gamma game. You have to like this fast fluctuation of prices. And personally, I like to play it slower. I like to have a more controlled approach and less. If I like action, I like to play my video games. I like to play my whatever there, without going into much detail. But if I want to have thrill, I'm not trading. If I want to have action, I'm not trading. This is a business, and this should be boring as hell. And those ultra fast expiry cycles, for me, this is way too much action. But that's just me. But you're right. Price changes will be reflected faster there. And for the more mathematically inclined, that is due to gamma. All right, all right, we seem to be good here. Other example, the Aussie, Australian dollar against the US dollar. We're looking at a 2-hour chart, we're looking at a 4-hour chart. 2-hour chart, nice move to the upside, beautiful uptrend, prices just pulled back once again to price equilibrium levels. 4-hour chart, exactly the same story. Price is pulled back, price is sitting in the buy zone with a small bullish candle just setting up. Same thing is true here. And yeah, 1 hour to go till daily expiry, which is too close, and therefore we have selected the weekly contracts. There are 2.5 days until expiry. Which contract will you select and why? First of all, I give you guys some time. Have a look at those different strike prices available here, and let me know which one you would be shooting for. Price is sitting right now currently at 1.1783. Those different strike prices are available. 2.5 more days going. So which of those would you pick? Just let me know using that small questions box. All right, so guys, thanks for the answers. I would be shooting here for the top one. Why? Because, well, we're sitting here at 101.783. The top one is 101.75, which is pretty much at the money. At the money, remember from previously, this is around about the conservative one. We get a one-to-one reward to risk ratio on that potential long trade, and that's good enough. That's not awesome, but that's good enough. And why would I pick that contract? Well, because all the other contracts here, they would already be deep in the money. And for that reason, contracts deep in the money do give me a higher probability on a potential long trade for winning that trade. However, the reward to risk ratio usually starts to stink pretty fast. And you can see it here. I'm risking 70 for that potential long trade for a potential gain of just 30. Next strike price here, I'm risking 83, 84 for potential gain of just 16. The reward to risk ratio becomes really, really bad down here. So personally, I would have really liked to shoot for something for a higher strike price. However, it happens to be that if the market move for quite a bit, and we can see that the markets have moved for quite a bit, that the strike prices available here for the weekly expiry cycles might not be the perfect ones that we're looking for. And then we have to look for what is there. Does it make sense for us? And if it doesn't make sense for us, okay, that's it. So be it. Move on to the next market, move on to the next potential trading opportunity. So in this example here, I would be shooting for the one at the money because it's the only one that makes sense for me, both from a probability and from a reward to risk perspective. All right, so let's have a look at the momentum breakout examples next. And Radha is asking another great question, but unfortunately that's way out of scope here for today. Radha is asking about seasonality and if there's a difference between Monday and Friday sessions, and if there are any changes. Seasonality is a very interesting topic. Thank you for bringing it up, but definitely way too much out of context here to dig in deeper here. But we'll keep that in mind for potential upcoming sessions. So thank you very much for that suggestion. British pound, Japanese yen momentum breakout trade, 15 hours to daily expiry. What are we looking at here? Well, why is it a trading opportunity? It's a nice short trading opportunity because we have a well-established downtrend here. Price is making lower lows and lower highs. We have set up a flat level here. Price is compressing against this flat level. At this flat level has now been tested 3 times. We're now just about to break below this flat level. We're looking here at a 60-minute chart. 2-hour chart for confirmation. 2-hour chart tells us exactly the same story. And what really sets this trading opportunity here apart from many others is we're looking at convergence here as we're about to break out in both MACD and RSI. While price went sideways here, and this is thanks to the steep pullback here, next test and next test, price is about to break out here to the downside. And if price breaks, there's a decent probability that we will get convergence on the break in both RSI and MACD, and that's crucial for that type of setup. I always want to be able to see convergence on the breakout. So nice trading opportunity here. So what breakout, what strike price will we look to achieve? Well, again, different ways to go about this. If we traded this the conventional way, and let me just move on here to the next one. Let's stay here for the first one. If I want to trade this the conventional way, my stop loss would probably be here in this area. Another candidate might be here, or we could be looking at this one. Personally, I would probably go in for this stop loss level. Now, why worry about stop loss levels when it comes to Nadex contracts? It can help me with my strike price selection. I would be shooting for a 1-to-1 profit target, which means if I'm entering on the break of this line here, this distance would have been my risk, and I would be shooting for that same distance here to the downside to give me my 1-to-1 profit target. So that price level right here, that might be a suitable candidate for a strike price selection. Again, another one would be the level itself. Remember, if it's trading at the strike price, it should be very close to 50. So I know the price. I should get a decent reward to risk ratio on that one. Not outstanding, but decent. And this one here, selling the strike price here at that stop loss level. Yes, it should be protected a little bit from that logical stop loss placement location. However, reward to risk ratio on that trade probably will be rather bad because it's at that point in time an out of the money trade. So this could be a rather not too aggressive, but somewhat a little bit aggressive strike price to pick. So that might be one. And the other one that I would consider would be here, the level itself. And the third one, yeah, probably not. Let's put it that way. All right, so let's have a look here at the next one. And higher time frames. We're looking at that same trade now. You're looking at higher time frames. And guys, guess what? Yes, we say it's pretty much that same setup once again. I see that this market is going lower. What makes this a little bit more not intimidating, a little bit weaker word for that. Here on this 8-hour chart, we are now currently really a little bit overextended. And this is why that's the one grain of salt that I can see here. But apart from that, all those different time frames have been perfectly agreeing. The 60-minute chart tells me this market is going down. The 2-hour time frame tells me this market is going down. The 4-hour, once again, we've doubled our time frame. This market is going down. This market is going down with a wee bit of overextension, not on the 1, 2, but the 3rd higher order time frame. That's perfectly fine. Nice setup, nice trading opportunity. So let's drill down back here to the 2-hour chart. What is it? What are the time frames and strike prices available here for trading? We're sitting at this 121, and if you remember, this is pretty much in this area where I said, all right, this 1-to-1 profit target might be sitting just here. So 121. I can sell this contract now for 55. 50, not outstanding, not great, but it's definitely okay. And the other one that I could be looking at is 120.40, which is way down here somewhere. And 120.40, I could be selling this one for 75.50. Once again, what's the right one? What's the wrong one? I don't know. You pick the one which you like best. And once again, why not trade both? You want to make sure that your total risk exposure remains the same. So if I want to trade just one contract, my whole risk is in that contract or in that strike price. If I want to trade 2 different strike prices and diversify a little bit there, then the risk, the sum of my risk exposure of those 2 contracts or more contracts, strike prices, should then total the same risk exposure as if going for just one single strike to trade. Way better reward to risk ratio on that trade here. You're risking 25 for an opportunity to make 75, 3-to-1 reward to risk ratio. Versus reward to risk ratio here, you're risking 45 for potential to make 55. But again, still okay. You're paying for this better reward to risk ratio with a diminished probability, because now price will have to drop all this way to 120.40 within the next how many candles? Well, we're looking at 15 hours. One candle is 2 hours. The next 7 candles. Do I think it is likely that within the next 7 candles, price will hit this level? Yes or no? Comes down to you to answer that question, what you feel good with. 5 hours later, price has started to drop down. Price is moving in your favor, but there's still approximately 10 hours until expiry. What are your options for your open trade, for your open position here? As I've said, it's not fire and forget. You can actively manage that position, which means if price has started to move in my direction, if that deep in the money trade is now sitting at the money, I can start to close out. If price dropped from 75 to 50, I can start to close down that position, to lock in some profits, to offset some risk on that trade. Think about actively managing that position. Next example here, Dow Jones Mini once again. And Dow Jones Mini, we're looking here at a call spread, 2-hour call spread. And which call spreads are we looking at? First, let's have a look at the chart. 2-minute chart. I've identified that the market has established a flat level. I see the series of lower highs. I see prices about to break out here to the downside. And that would be my entry level. 1 5-minute chart pretty much tells me that same story. And I know that the higher time frames are in a downtrend. Otherwise, the 200 period moving average and the 50 wouldn't look the way that they do here. So all this coming together, yes, I have support from or confirmation from higher time frames. Which of those contracts might I be interested in? This level is currently sitting around 11, yeah, around about 11,300, 11,292. Remember, if I want to establish a position in a call spread, a short position, I want to enter as close as possible to the ceiling. Because if price starts to rally, I'm already sitting at the ceiling. Price can't go against me much further. I'm already sitting here at the top. I can lose what I'm paying for this contract right now. So here right now, if I want to sell this contract, I would be selling for 11,274. So my risk would be just those 26 points, and that's it. I can't lose more than those 26 points here. However, if price starts to drop now all the way to 11,200 points, I'm in for that complete ride. So this is the one contract that I would be looking for. It doesn't make sense to sell a contract where I'm sitting at the floor. I have all the upside risk with no real gratification for taking that risk, no potential reward. And this one here is just sitting in middle ground, sweet spot, doesn't do anything for me. I definitely will always go in this type of scenario here for the bottom one where we're trading right there at the ceiling level. So what happened next? The entry was here. We entered here at the ceiling and price pretty much started to drop all the way. However, at the expiry, price started to rally at some point again. Multiple opportunities for taking profit prior to the 2 p.m. expiration. How would you have managed profit targets? Just put in limit orders. Once that trade has triggered, once you're in that market, just put on those limit orders and start to scale out of those positions. Usually, personally, just my cup of tea and my style of trading, I like to take half of my contracts off if I hit a one-to-one profit target. There, I have still a lot of remaining contracts usually to shoot for a nice reward to risk ratio. However, at that stage, I pretty much should be able to lose any money on that trade because I have already hit my first risk profit target and I've taken risk off the table. Hope that makes sense. Next example, Australian dollar, US dollar, call spread, daily expiry cycle, 5 hours approximately left. So what is it that we can see? The 4-hour chart was on a very nice uptrend. However, price fell apart. We started to see lower lows. We started to see lower highs here. So clearly this uptrend is over. Price is about to push lower again. The 10 has already crossed below the 20. So price is pushing to the downside. The 1-hour chart is about or has established a flat level here with 2 touches. We're about to see that the market is going lower. I would like to drop down to lower time frames to get more confirmation here. But the big picture here is price might be shooting lower. So where are we trading right now? Sorry that it's so small. Again, how do I pick which call spread to pick or to choose here? Same story. I want to pick that one, which is I want to initiate a potential short trade. I want to enter as close to the ceiling as possible. So what are my different strike ceilings available here? 108.30, which is pretty much where price is trading right now. And therefore, I just don't have to look at the others. That's the sweet spot for me. I'm entering at the ceiling level. I should have much more way here for price to drop all this way. And if price starts to rally, well, I'm losing those 15 pips that I'm now paying for this contract, but that's just it. Guys, don't get confused if you have a look at the call spreads and see the maximum reward. This is really the maximum reward if price moves to or beyond the opposite side of where you entered. This is so the maximum reward shown for that contract here will only be achievable if price really drops to 106.30 or below that. That's the one big change here, the flexible payout structure of those call spreads. Don't get confused there. And it's really just keeping the downside in check, looking at the potential loss, at the risk, and try to balance this. But the reward to risk ratio is not as good as a indication of which one to pick as it is with binary contracts. Hope this makes sense. So what happened next? Well, price clearly dropped all this way down here, and sure enough, this is reflected here with what we see in those contracts. I can see the top contract here pretty much didn't move at all, and even there's no bid. Because why? Because this would have entered there right at the floor level. You would have taken all the risk, but there's no reward to be had. Here you entered with pretty much all the potential reward available, with a very small defined risk exposure here. Guys, does this make sense? Especially with the floor and ceiling levels when it comes to call spreads. This is really the big takeaway here for call spreads, that you want to understand the floor and ceiling levels and how the risk structure for those then actually works. Scott, thanks very much. Really appreciate that. All right, so let's move on. And quick warning, we have about 15 more minutes left. Decent chance that I might be over time. I try to speed it up. A complete trade analysis from start to finish. Gold momentum breakout on those lower time frames. Here we're looking at the gold contract, 60 minutes and 2 hours, 1 hour, 2 hour. What is it that we see here on this contract? Price is in an uptrend, and I have not analyzed this area over here. I just don't care. I just see that we're making continuously higher highs and higher lows here in this move, and that's good enough for me to say that the hourly chart is an uptrend. Sure enough, I have my fanning pattern and my moving averages, all those things coming together here. All this looks very nice and dandy on the hourly chart. Yes, I have established, or price has established this flat level, another flat level down here. So that's the big picture. Good convergence here, good momentum in my indicators. All is really looking nice. 2 hour chart, what's going on here? On the 2 hour chart, we start to see that, guys, just let me have a look at, yeah, that's way more zoomed out. Sorry, was a little bit confused now. That's way more zoomed out, and sure enough, price is sitting here at this level, and you start to see that this level is way more pronounced. It just goes way more back than what we saw here previously. Well established level, 1 touch, 2 touches, 3 touches. Now the market is reacting again. You can see that price reacted here with that small red candle, finally broke above it, came back to test this level from above, seems to establish this flat level. All this coming together, suggesting that price might be shooting higher here. Hourly chart, 2 hour chart all suggests that this might be a bullish environment for the market to follow. 4 hour chart and 8 hour chart. 4 hour chart, yes, the level is much easier to spot here. Quick exercise or quick tip: zoom out, try to find those levels on high time frames. It's much easier. Remember when I told you guys about the noise on those faster time frames? This noise makes it difficult to spot those levels, but you can start to see that the way more we zoom out, the easier those levels become to spot. And here, even on the 8 hour chart, we just are able to see that, yes, the market has reacted to this level also here several days ago in the past. So do yourself a favor, try to identify the really significant levels on higher time frames, and then drop down to those lower time frames to identify trading opportunities there. 4 hours, fanning pattern, price is shooting higher. 8 hour, pretty much the same story. All this suggests that this market here is going really strong. And yeah, just a lot of good things happening here. Daily chart, weekly chart, monthly chart. You might still argue that the daily chart had this huge move lower. However, we have established this level and about to move higher. And I've actually broken this small level here again. But yes, the daily chart overall, that's a mortgage to be aware of here. However, the weekly chart already tells a completely different story. The weekly chart tells me, Philip, we have been so overextended here from price equilibrium levels that snapback just had to happen at one point or another, and we got this snapback. Now, we're once again at price equilibrium levels, and we're about to establish small bullish candles setting up here. So very supportive, good, nice environment here for gold on the weekly chart in this example. And the monthly chart, yeah, perfect uptrend, nothing whatsoever, and just, yeah, overextended on the monthly, and this overextension has now been fixed. So what is it that we do have here? We have a beautiful, strong as can be call from the monthly. This on its own could be tradable on the monthly chart. This on its own might be tradable on the weekly chart. I just said might be, but because traditionally trading, there would be my entry and my stop loss would be there. And this is way too large here. Nice thing about Nadex contracts, forget about the stop loss, just try to find the perfect contract here and go for it. So perfectly tradable here. Very bullish environment, but not a trade setup here on the weekly chart. And everything from the daily going forward is about to already break out and move higher, or on the hourly chart is already has broken out and is just coming back, giving you potential trend flow opportunity on top of this momentum breakout on the 2 and 4 hour and 8 hour chart. So how can this be traded? And I'm trying to get back my laser pointer. Here it is. So different call spreads available for trading here. And let's just jump back briefly here. We're sitting right now at 1683, just to get the price level right. 1683. Now, I have call spreads. 1675 to 1725. Not bad. I have 1650 to 1750. Now, this is pretty much the same center. Both contracts have their advantages and their disadvantages. Here, I'm limiting my upside. On the other side, I'm cutting my risk. Obviously, I want to buy this contract. So rule of thumb, I want to enter as close as possible at the floor level of this contract. 1683 is just not there. So technically speaking, yes, 1675 would be, from a risk perspective, the one with less risk because I'm entering closer to the floor level. However, the downside here, if gold really starts to rally, my rally stops at 1725 per troy ounce. And this contract would give me potentially $25 more range for that gold contract to move. So that's a spread with a wider range. Once again, it comes now down to your personal risk preference. What is it that you like? Do you think price, if you're happy to say I want to have less risk and I'm just shooting for 1725, that's perfectly fine. If you say, no, I'm willing to accept more risk per contract, therefore trade a smaller position with the same absolute dollar risk exposure, but I want to shoot for a potentially larger profit target here, this is your personal call. It comes completely down. Jess is asking, isn't risk to ratio the same on these two? Pretty much yes. Pretty much yes. You risk 25 more here, but you have the potential to make 25 more there. It really comes down to how bullish are you about that move? The one thing that I want you to understand is I'm taking more dollar risk here. What do I mean? If I trade one contract here, my maximum loss is $353. Trading one contract here is a maximum loss of $154. I want to have that same risk exposure dollar-wise per trade. let's say I have a $25,000 contract trading account. This means that I'm willing to risk about $250 per trade, 1% of that account. And now I just have to, this contract here, for example, according to my rules, I mustn't trade that contract because I'm willing to risk 250. However, my maximum loss here would be 350, which would make me move personally to this one here. I could be trading one contract here. You are right that the reward to risk ratio on that trade, it expands on both sides of the spectrum. So pretty much should be constant with what we're seeing here. This is now just, is your account large enough to muster and handle the risk of that trade, that move? And do you think you need that more downside risk in order to give you your bullish aggressiveness here on the move higher? Completely your personal call and comes down to your personal situation. Looking at binary options, game is different. We're looking here at where is the market trading? It's trading around about at 60.83. Guess what? 16.84 gives me a price which is very, very close here to 50. Once again, if the underlying market is trading at the strike price, the price of that binary option should be very close to 50. So how much time is left there? This is a weekly expiry, so we do have more time in this life cycle of this contract. And now the question is, coming from the chart, looking at everything, how aggressive do you want to be? How aggressive do you want to be? Time remaining, sensible strike, potential reward, total risk. And this is in the end, once you know that you have to cover all those, or should be thinking about all those different attributes of that trade, in the end, this is a question only you have to answer for yourself. I feel that within certain limits, there is no right or wrong answer here. Weekly binary options. Why might you select the weekly expiration? What advantages and disadvantages does it bring? Well, obviously, more time for the trade to work and play out. Once again, same logic. Before we had the daily expiry cycle. Here we're looking at the weekly expiry cycle, and 16.8250 price very close to 50. Why? Because it's trading at the strike price. So that would be one. Or if you say, no, I've seen everything from the weekly, from the monthly down to the hourly chart. I feel that the market is indeed really pushing higher, and I want to give this trade more wiggle room to work out. You could then start to think into looking into strike prices which are further out of the money, because trade has more time to reach those strike prices. Once again, it comes down to your personal preference. And just food for thought, could it make sense in this instance to mix and match a selection of call spreads and binaries, or binaries with different expiry cycles, or binaries with different expiry cycles and or strike prices? You can completely structure that trade setup the way that you want it to be. Let's talk very briefly about surviving the learning curve. And guys, I feel that this whole trading psychology and mindset and risk management is so important. I would love to do a very dedicated session for that. Unfortunately, we don't have time for this here today. The rate of someone's progress in learning a new skill is the definition for the learning curve. It's a good thing that we human beings, we can learn. We cannot learn as fast as Google's DeepMind and artificial intelligence neural networks, but we can learn. And the benefit of learning is that we will make errors less frequently. The bad thing is that in the beginning, we will make a lot of errors, and we must make sure that we will survive those errors. Typically during this period, precautions are taken. And I do not suggest that once you know how to ride a bike and know how to ride a motorcycle, that you will then turn off your helmet. I would be wearing this all times, but your stabilizers might be gone for good. So this is how you want to approach your trading as well. You want to make sure that no matter what happens today, that you are in a sweet spot to potentially survive today's market action and come back again tomorrow. Keys to survival. absolutely crucial. And this is boring as hell, but it's so crucial because this is how we survive today's market action. We manage risk first and foremost. We accept that risk exists in trading and build a plan to mitigate it. 1% maximum risk. This is what we practice, this is what we preach, and this is what is pretty much in line with every professional that I know in the market. Stay small with your trades. This rule alone can put you among an elite trading group. Why? Because 80–90% of all traders, they blow out their accounts within the first 1 or 2 years, maybe. Some maybe even within days or weeks. They trade way too large. If you're willing to risk just 1% of your account on any one trade, so if that $25,000 account, if the trade does not work out, well, I just lost $250. Is this nice? No, it isn't. Does it kill me? Absolutely not. Because now I still have $24,750 available for my next trade. And can you make a killing trading the markets with such small positions? Oh, yes, you can. For sure. Because think about reward to risk ratio, think about winning more often than not, and think about the power of compounding. Compounding works heavily for you with this type of risk approach in both losing scenarios, because you will scale down your position size if you have a series of losses, and it will work tremendously for you in a series of winning trades because you'll expand your position size. You don't have to win this tonight. This is not just a marathon, this is an ultra marathon. Run over the next 10 years, 20 years. Don't try to win it tonight. You're in there for the long run. Avoid overconfidence after a few winners. Trade small, begin with. Even if you have $25,000 for your trading account, why not artificially decrease your position size to think, all right, I'm just willing to trade with 10,000 of those dollars. So I'm willing to risk just $100 per trade, or even smaller. That's the nice thing, again, with Nadex contracts. You can actively manage those trades. You can really start small. You don't have to have a large account to actually trade those markets, those many markets across so many different time frames. David, thanks again for confirming here. Oh, that overconfidence thing is a big one. So easy to think you've got the hang of it after a good run. Yeah, absolutely. And I completely follow suit with your next statement. Keep demo trading. Stay humble. The market will come back to you. And if you just follow the rules, if you just stay small, you should be able to survive pretty much any market environment. And once you've got the hang of it, once you know how to trade the markets, you're there, and then you can go full throttle because you know how to do it. So create your own risk management plan. Here's just a template. What is it? What can you do? My trading capital is. How much money is really available for your trading? No, not the money that you owe your landlord for the next month, the next payment for the car, the next insurance bill, the next whatsoever, not the college fund for the kids. What is really play money? Money that is, if it's gone, and it's not nice, but who cares? That's your trading capital. Risk management is important because, in your own words, why is this truly important? Why is survival so important? The maximum % risk I'm prepared to take on any trade is, and this combined with your trading capital then results in the maximum dollar risk that you're willing to take per trade. Now we're talking about so-called circuit breakers. The maximum dollar daily loss I'm prepared to take is, personally, for me, it's not a dollar daily loss, but rather a maximum loss series intraday. If I'm trading the index markets intraday and I have 2 or 3 losing trades in a row, I know that I'm approaching my poker tilt mentality, which is I'm just no longer there in my happy place. I'm just getting angry. I just have a decent probability of switching into revenge trading mode. And I know that I just have immense potential at that point to really screw up my trading account. And this is why after 2 or 3 losing trades in a day, I just say, all right, that's it from me for today. I will be back tomorrow. I'll be back. That's it. Define your personal circuit breakers. When are you no longer at your best? And when does it just make sense to take you out of the game? I will stop trading immediately and do a trading review if my account falls by X% in a day, in a week, in a month. I mentioned that I want to have a minimum reward risk ratio of around about 1:1. Again, that's just our style of trading. Your approach might be completely different. If you think probabilities are way more important and you're happy to risk 2 in order to make 1, backtest it, try it. You have to find something that works for you. Also very important, if I do break my risk management rules, define some kind of contingency plan here to make sure that you will get back on the horse, that you will follow your rules again. And guys, once again, to err is human. We are all human beings. We will all screw up. Screwing up isn't the problem. It's just realizing that you screwed up. Take a deep breath, exhale, step back, think it through, don't beat yourself up, and then just come back and trade and try again the next day. All right, guys, let's wrap it up for today. A little bit over time, sorry about that. You can use Nadex contracts for any scenario where you have a view on the market from the next few minutes to the next few days. We talked about those different expiry cycles, 5-minute binaries to weekly binaries. Great opportunities are to be had there. Other strategies that we here at Trade with Position use are trading at support resistance. If you think about it, that momentum breakout trade is essentially just cashing in on the breakout of one of those support and resistance levels. Another approach might be trading the opening gaps on index futures, news trades. We have about, I think, 24 minutes before British Parliament is about to do another Brexit vote. And yeah, definitely has potential to move the market. So maybe looking at the British pound and those pairs, I don't know. We just have to watch those markets and see what's going on there. But those news events are always catalysts for market moves. Reversal trades, of course, as well. At some stage, we may extend this 3-part series to include more trading setups. And personally, I would really love to do more about risk management and trading psychology. But now it's your call. You let us know what you want to see. If you want that series to be expanded, I already got many very favorable feedback here during that session. Thank you very much, everybody, for those. And really appreciate the feedback. Definitely makes my day. And let me just, yeah, perfect. Guys, webinar summary should be coming, survey should be coming up. And yeah, all your feedbacks is really appreciated. And also, of course, feedback by email, customer service@nadex.com. Anything that you have for us will be reflected and incorporated for those next webinars. So thank you very much for tuning in today. David, Ludmila, Charlie, thank you very much, everybody. Really appreciate the feedback, guys. And Valma, just shoot us an email, or yeah, just shoot us an email here at customerservice@nadex.com. And yeah, already excited to hear your feedback, guys. Thank you very much for tuning in, and I'm looking forward to welcoming you guys again during our next upcoming webinars, market movers, market commentary sessions, and so on. Looking forward to talk with you guys again then. Thank you very much for tuning in. Take care, happy trading, and all the best. Cheers, bye-bye.